Brad Williams, Frugal Finance. How about coupon bonds, current yield, and yield to maturity? What? Hey, I'm just going to throw it all at you, okay? We got coupon bonds, we have a current yield and a yield to maturity. There's different calculations for current yield, yield to maturity. We already talked about current yield. We're going to delve into yield to maturity. A coupon bond obligates the issuer to make periodic payments of interest, called coupon payments, to the bondholder for the life of the bond, and then to pay the face value of the bond when the bond matures, i.e., when the last payment comes due. Periodic payments of interest are called coupons because at one time, most bonds had coupons attached to them that investors would literally tear off and present to bond issuers for payment, hence coupons. The interest rate applied to the face value, that means the original bond. That's the face value. To compute the interest rate applied to the face value to compute the coupon payment is the coupon rate of the bond. So a bond with a face value of 1,000 paying annual interest at a coupon rate of 10% requires the issuer to pay 0.1 times 1,000 equals $100 every year. If the bonds mature in 6 years, then at the end of 6 years, the issuer pays the last coupon of 100 and the face value of 1,000. Cash flows from these coupon bonds are displayed in figure 8.2. We see that the stream of promised cash flows has an annuity component, a fixed per period amount of $100 per year, and a balloon or bullet of 1,000. Current yield equals coupon divided by current bond price. 100 divided by 950. Current yield, 100, 950. Yield to maturity, 100 plus 100 minus 950 divided by 950, 1579. Current yield, 100,050, 10% rate, 952. Yield to maturity, 476. I'm not sure about this one here, but we'll just go with it. The reason being, I showed you yield to maturity in a previous session, and we're missing, this number needs to be 1,000, or whatever the price is, 1,000 plus 1050 divided by 2, and this needs to be divided by something. Current yield, coupon, divided by current bond price, divided by 950, 10 rate. All right, so here again, we have this rate to 100, 950, and 723. This may be a little bit closer. I'd have to check. $100 annual coupon is fixed at the time the bond is issued and remains constant until the bond's maturity date. On the date the bond is issued, it usually has a price equal to its face value of 1,000. The relation between price and yields on coupon bonds is more complicated than for pure discount bonds. As we will see, when the price of coupon bonds are different from their face value, the meaning of the term yield is itself ambiguous. Bond yield to maturity, coupon bond, the right of a bond buyer to receive interest payments based on the bond's face value throughout the life of the bond at the coupon rate. Current yield, as we just discussed, is coupon divided by current price. Coupon bonds with a market price equal to their face value are called par bonds. When a coupon's bond market price equals its face value, its yield is the same as its coupon. For example, consider a bond maturing in 1 year that pays an annual coupon at a rate of 10% of its face value of $1,000. The bond will pay its holders $1,100 a year from now. Coupon payment of 100 and the face value of 1,000. Thus, if the current price of our 10% coupon bond is 1,000, its yield is 10%. Coupon bond 100 divided by 950, 10% rate. Brad Williams, Frugal Finance. Thanks for watching.